The 5-week winning streak was broken last week, as the S&P 500, along with many of the other domestic indices, saw red. The Emerging Markets Index was the lone positive performer of the major markets after seeing 2 consecutive weeks of losses. The weakness was also present in the S&P Style boxes, as 8 of the 9 capitalizations ended lower, although no loss exceeded a percentage point. The economic calendar was dominated by a number of reports measuring inflation. Tuesday's Producer Price Index shocked many analysts as the measure of wholesale inflation rose 8.6% year-over-year for October. This was followed up Wednesday by the 6.2% year-over-year increase in the Consumer Price Index. This jump in the CPI marked the highest rate of inflation for the index in 31 years. These reports, designed to measure various forms of inflation, caused additional consternation within the market around the Fed's handling of interest rates. The CME Group has a tool called the FedWatch Tool, which calculates unconditional probabilities of Federal Open Market Committee meeting outcomes to generate a binary probability tree. This tool had an over 80% probability of rates remaining largely unchanged for June of 2022 until we entered into the month of October. Since then, the FedWatch tool has evolved to reflect an over 65% chance of the first rate hike taking place in June of next year, followed by an 82% chance of an additional rate increase by the December meeting of 2022. Meanwhile, Treasury interest rates rose again last week. One interesting note is that there is currently a slight decrease in the yield between the 20 and 30-year durations. This type of behavior can be a potential warning sign to bond investors of a possible recession on the horizon.